All right, welcome everybody. Thanks for joining us today. We are very lucky to be joined by Mark Roberge, who is formerly of HubSpot, was an early employee there and CRO, who led their growth up to $100 million. He also is a VC at Stage 2 Capital and has written the fantastic book, The Sales Acceleration Formula. He has a new book out, The Science of Scaling, which is what we're going to be chatting about today. Welcome, Mark.
Thanks, Mark. Good to be here.
And we've also got Dave Shepherd. So Dave has been a sort of mentor of mine, a person I call occasionally to double check that what we're doing at Quilla isn't totally insane. He has also an early HubSpot employee, ran the sales team and also ran HubSpot out in Australia and New Zealand the last 5 years, I'm going to say, Shep. And is recently retired, spends his days golfing, fly fishing, just having a great time. So we're happy to have you join too, mate.
Thanks, Mark.
Mark, so just to kick us off, I thought it might just be worthwhile. We're sort of talking about the science of scaling here. The sort of general overview of the book is it explores, I think as the sales acceleration formula did as well, it sort of takes an analytical and somewhat scientific look at a lot of these sort of semi-amorphous topics that we discuss around like product market fit and like how to find go-to-market fit and then how to actually scale that, where there's a lot of voodoo and bullshit out there, and it tries to sort of break that down and give some rigor and some structure to it. So what led you to this book, and sort of what are your goals of writing it and putting it out there?
Yeah, sure. So it's still a work in progress. I would say it started as a PowerPoint deck probably 2-3 years ago on the stage of SaaS. This is just how I kind of create work, right? And then it just iterate, get feedback, keep speaking about it. And then when COVID hit, that was a great opportunity to codify at least the early workings of it. So it sits as a 40-page ebook on Stage 2 Capital's website. And that will eventually be a book, I would hope. But it's still like, I'm still getting more and more feedback on it. So the way it originated was when I bounced out of HubSpot, and then I wrote Sales Acceleration Formula, and then I was recruited into Harvard Business School to teach at the sales and the MBA program. And one of the attractiveness to that role was it gave me a lot of autonomy and even encouragement to stay very active in practice. And I love startups. So I basically leveraged that time by parachuting into a different startup every quarter and going to their office one day a week and just kind of listen to calls, like talk to the reps, talk to the customers, look at the data, and basically generated sort of a go-to-market assessment for the board and the management team after about 6 weeks of being there on what my perception of their biggest risks were and how to offset them. I did that for a couple of years, like a handful of companies. Some became unicorns, some flatlined. And that's really what like piqued my interest, is reflecting on that experience, plus like a whole bunch of others that I just was less intimately involved in. Like, why does that happen? Like, why do some of these companies take off and why do many of them fail? And that reflection kept coming back to two key questions. When are you ready to scale sales? And how fast? And I just saw a lot of poor responses to those questions and poor advice on those questions. And that's really what led to the framework, is like, wow, like, can I kind of reflect on those that succeeded and try to codify in a data-driven scientific way how entrepreneurs should think about those questions. And so if we just start with the first one, Mark, like, when should you scale sales? That the answer to that has improved in the last 15 years, thanks to Eric Ries and the Lean Startup and Steve Blank and product market fit and agile software development and involving customers. But so everyone says, oh, product market fit. And I think that's a good answer. The problem is when you ask people, well, what is product market fit? If you ask 10 entrepreneurs, you get 10 different answers, which is ludicrous. You get everything from something super subjective of like a big, a workable product in a big market, to stuff like when you hit $1 million in revenue, which I think revenue is a terrible measure of product market fit. Like, that's your ability to sell, not your ability to generate customer value, right? So that was really the inspiration behind the continued work there.
So awesome, thank you. And I think let's dive into the product market fit side. I will now hit you with my of the 20 versions of the founders version of this. I'll hit you with my peculiar sort of version. I mean, I think the thing that, and I think that actually reading your book actually like clarified some really important things in my mind. And I'll tell you my sort of journey. So something I've been sort of thinking about for a while is that there's this, I think there's the one that I'd like maybe love to push on you a little bit is to be like, product market fit is something that I think a lot of founders view like, oh, I have product market fit, like check, they're done. And I have a feeling that like it's the way that I describe it to other founders is like, at least on our journey so far. And again, my answer may have slightly changed after reading your book, but is it sort of the analogy I use is like gears in a car. Like most startups never ever click into first. They never ever get a channel that starts to work. They never ever get like find real value for a customer, find the right segment. But first is wonderful. First is better than no gears, but like you can't live in first. You need to sort of be able to click into second, click into third. And so I've been sort of equating it with, that's to some degree, like it might be, you start with a very small segment and you find a channel that works to get into that segment. And then you sort of then go to a bit of a larger, segment or customer base, or maybe you're moving up market a little bit. But each time you sort of change focus, you need to like rethink a little bit, hopefully not your model too much, but sometimes your model, but certainly like the channel that you go after and how you sort of think about that. And it is, I say this right now, maybe Quilla's in like third gear, desperately trying to click into fourth. And it's like, it is each stage of that is a challenge to sort of realign and we're very much moving up market. To sort of realign your messaging, realign your marketing. Aaron, who's on the call, knows that we have conversation about this all the time. I think the thing that I loved about your sort of framework for it, where you sort of say product market fit is really around customer retention. And then if you don't have incredibly high customer retention, and so I think in the PowerPoint deck, you had this line of like 90% customer retention, at 12 months, and then, about 100%, ideally 100% net revenue retention. That's like, and then you sort of have a nice framework for like, okay, that's such a lagging indicator. How do you bring that forward a bit? But I think that's a really wonderful way of thinking about it, because I do think that is like real value, people sticking around for a long time. Like that is the whole game with SaaS sales, you have to be long-term greedy, etc. And I think the thing that actually sort of solved for me mentally was like, one of the things, so when we started in SMB land, we had relatively high churn. And as you know, like high churn means that curve of the S-bend is like very, very real. And so all of a sudden, even if you're adding a lot of stuff top of funnel, it's very hard to grow at a meaningful rate. And I do think all of a sudden I was like, if you do actually solve retention in a meaningful way, especially if your net revenue retention was ever so slightly over 100, that actually does allow you to scale in a much more powerful and meaningful way. And it did, which is, again, to be frank, as our journey goes in moving up market, that is like one of the core drivers was around like, we had this nice segments in this lower thing that were wonderful in the early days and helped us click into first gear and, blah, blah, blah. But definitely was a sort of core driver in us sort of doing a bit of a move there. And that, I think, sort of solidified that. But I suppose like just to sort of tack back to that, how does that sort of gears in the car analogy sort of sit with you? And I suppose to sort of tie that into like a HubSpot question I had, I think one of the things that I've always been super impressed with HubSpot is they were quite famous for like IPOing at like sub 100% net revenue retention, like sort of about 90 or so. And now they're up to like, they're well up, I'm going to get this wrong, but 110, 120, something like that, which is like very hard to do at an organization that size. And so I suppose like my question would be, in fact, I'm just going to start with, I've got a whole bunch of questions. I'll just sort of start with, what do you think of the gears in the car thing? And then I'd also love to.
There's a lot in there. There's a lot. And you got me thinking, because that's why I like doing these, because you got me thinking about what a good analogy is. It's not quite crushing it for me on the gears of a car, because like, it's almost like a sequential thing. And you technically could like skip out of first gear and go right into second if you're like on a hill or something, and it doesn't like ruin so that's the problem, I think. But you got me thinking, I think it's like building a house is probably better, where like the foundation is product market fit. And if you built that wrong, like in the bad place, or like use bad materials and it had cracks in it, the first floor, you can build an awesome first floor, but it's going to fall apart. Right. So that's probably a better analogy. And you just inspired me around that, Mark. So thank you. So that's the whole point, is like, this is a sequential framework of product market fit, then go to market fit, then growth and moat. You can work on the go to market fit and growth and moat stuff, but I encourage you not to, honestly, because it's so hard to acquire product market fit from the ideation phase. I really think you should channel all your resources at it. Okay. And so to your point, that was the thing I was thinking about, was how can I codify this? Like, what if I had to rest product market fit on a metric, which one should I pick? And, Sean Ellis probably has the closest one I've seen that I kind of like. If you read the Wikipedia page of product market fit, he talks about if you survey your customers and 40% of them say they can't live without your product, then you have product market fit. That's good. It's quantified and it's not focused on revenue. It's focused on like customer perception, success, and value.
Yeah.
My only beef with is I hate surveys. Like surveys are riddled with false positives. Like we've all taken a survey for a founder and said good things because we don't want to hurt their feelings. And that's my only hesitation. So when I thought about that, well, what's the metric I'd rest my hat on that? As you point out, it's retention, and in the industry, if like we all operate in SaaS, like you can, I've done some work with like sweatshirt companies and baby stroll companies and like non-tech companies on this stuff. And it's a little different, but if we're talking about the world of software and SaaS, then I would say it's customer retention. And we've often talked that like in the startup community, 90% annual customer retention and 100% annual revenue retention is world-class. So that's the goal. But as you point out, in your stage at Quiller, I need to learn a little bit more about it, but like when you're in the early sequences, you can't it's going to take a year. If you acquire a bunch of customers this summer, it's going to take a year for you to know like what their retention rate is. And we don't have that time. Like we can't sit around for a year and be like, I wonder if we have product market fit. You know what I mean? So that's where the whole concept of a leading indicator to customer retention is critical. And that's something we just need to talk a lot about. Like if you're a seed funded business, a Series A funded business, your first slide should be about your progress on achieving the lead indicator of customer retention for your customer cohorts. Okay. And so now what should your lead indicator of retention be? Well, there's no universal answer. It's not like it's like set up the product for everyone. Okay. So I've given some examples in the book, like Slack's pretty, like the literature you read on it, it's like 2,000 team messages sent in 30 days. Okay. It's good. Well, first off, let me back up. It's like the format that I like to like promote is P% of customers do E-event in T time. Okay. So you isolate your definition down to 3 key variables: P%, E-event, T time. Okay. Slack, 80% of customers send 2,000 team messages in 30 days. Okay. Dropbox, 80% of customers back up their PC in 1 hour. Okay. HubSpot, I know this is the case, and Shep was there when we were doing this. Like, I think it was 75% of customers use 5 or more features in our 25 feature platform within 60 days. Okay. If those things happen, I'm much more confident in product market fit, and I can really measure those things, and I can revolve the entire organization around that. Like picture a 23-year-old customer success manager. Hey, welcome, Mark, welcome to the company. Okay, great. What's my job? Your job is to retain 90% of your customers. It's like, all right. I mean, that's stressful for a 23-year-old. What do you do? Compare that to, hey, Mark, welcome to the company as customer success manager. Great. What's my job? Your job is to get 80% of our customers to use 5 or more features in 60 days. Product manager. Why are people not using 5 or more features in 60 days?
Yeah.
Salespeople. Why are some of your customers not using 5 or more features? And it's just like it revolves everyone on a beautiful North Star. So that's really, what I'd hang my hat on. And for our portfolio and the companies I advise, et cetera, I push them toward that in the definition of product market fit.
Mark, I have two quick things I want to call about that. The first, directly around your P percentage of customers, E events, and T time, that has to then back into the ultimate retention numbers, right? And so, I can see a world in which entrepreneurs might game it and be like, oh, I think that it is, we'll use a HubSpot example, 75% of customers need to do 5 apps in 90 days. But if that doesn't ultimately lead to the retention metrics that are the lagging indicator, it's all for naught.
Not really. It's a great question, Dave. And let's bring that up. Dave, it's funny, Mark. I think I probably hired 600 people. I remember everyone's interview. I'm trying to remember.
Right skill.
Like, I think it came up that you were the first person that I hired that was on SportsCenter. I know that was the case. I just didn't know if it came up in the interview, because he was with Tufts. He was like, were you captain of the basketball team?
Yeah,
and he
that's
made
right,
this like pretty famous layup, and he was on SportsCenter, so that was pretty cool. I just don't remember what room was the interview in. Do you remember? I don't know. Maybe you don't remember.
We were at the old building, the the startup hub. Yeah.
Jeez. Yeah. I'll have to try to remember that. Okay. Yeah. Anyway, so it's a great question, Dave. So here's the deal. Like, let's say that Slack guesses in the first year of Slack that it's 2,000 team messages, and let's say that a year goes by, and you're absolutely right, Dave. After a year, you should check if it's right statistically. Okay, so what you can do is be like, okay, today's October, 2020. Let's look at all the customers we acquired last summer. Okay, let's look at all the customers we acquired from June of 2019 to like October of 2019. So they've all been around for over a year, and let's say we acquired 50 customers. Okay, so it turns out that 40 of them had hit the lead indicator of retention that we defined. And the overall retention rate of all 50 customers was, say, 85%. And the retention rate of the customers that hit it is like 95%. Okay. And 10 of them didn't hit it. 10 of them did not hit the number that we defined. And the retention rate for them is like 35%. Okay. Bam. That's beautiful. Like, that is statistically proven. That's enough of a variance. We've learned something about our business, and we're going to build on top of that. Okay. Now, let's say we didn't find that. Let's say same sample set, 50 customers, whatever, retention rate was 85%, but the difference between the two was like small, like 89% retention for the folks that hit it, 83%, we didn't hit it. I don't think you wasted your year. Okay. I don't think you wasted your year by focusing the organization on getting all your customers to send 2,000 team messages in 30 days if you're a collaboration software, right? I don't think you wasted, that was a waste of time. It's just that it's not quite the right metric. So what we have to do, hopefully we've logged a bunch of data, and now we can look back on the past year and actually figure it out in this week. We go, well, what if we increase it to 3,000 team messages? How many of them hit 3,000 team messages? Is there enough? Or maybe it's not the team messages. Maybe it's the number of employees that are using it. Maybe it's not about the total messages. Maybe it's like, once we get to 10 or more people, then that's the correlation. So that's my point, Dave, is like, you don't waste the year as long as you choose something that is like you believe is truly correlated with long-term retention. And then after that year, when you run the analysis, if it was wrong, you're probably going to be able to calculate what is right and move forward from there.
I think on our side, we certainly had so Quilla, document creation platform, create your sales, collateral, sales and marketing collaterals as interactive web pages. So you can use all the power of the web rather than, understand like analytics, blah, blah, blah. So we had a thing from our side, which was like, create a page, have it be in our but this was like an activation metric, which we were like very driven around for a while.
It's perfect.
I think was a useful framework to get started. And we've actually changed a little bit. So the initial journey was like, you've created a page, you've sent it to a third party, they viewed it. That then triggers a view notification that comes, like, if that's in HubSpot, it comes back to HubSpot and is like, hey, this document has been viewed. If you're doing it just normally, you get an email or a Slack ping or whatever. But that notification is like such a little powerful thing of like, oh, it's a web page. Oh, I'm going to be notified that it's been viewed. Oh, I can now go and see, who it was, what section they looked at, blah, blah, blah. And I think the thing that's actually meaningfully changed for us when we did regression analysis and looked at what actually moved the needle was like, it actually wasn't about hitting a view notification in the first 7 days. It was about having, because we're contracting like proposal platform as well. If they haven't a proposal accepted in the first 30 days, that is of such a higher value outcome. And actually that really drives the I am getting value for this product so much so that I will stick around and pay the fee, bear the cost and be happy to do so. That was actually the core driver there.
That's super powerful one. Cause I think it started to surface like different categories of selections of your event.
Yep.
Like there's ones that are very setup oriented. Those are good. Like just set it up. There's some that are usage oriented, like weekly active usage or certain like HubSpot's like 5 or more features. And then there's some that are ROI driven, which you found, Mark, which is like you actually got a proposal accepted. So like I would imagine as we continue to hammer on this framework, like the ROI driven ones are the most powerful. But not everyone can see that value quickly, but that's pretty cool.
So I've got one observation, and then I'll flip into a question. So one observation on the, so just a personal story. So on the Sean Ellis framework, which is, that 40% of people, would be, devastated if your product went away tomorrow. I like that framework too. I think it's useful, and something that I would just encourage founders out there to sort of think about, and even sales and marketing leaders at a certain stage, is one of the things that we did. We were doing a big segmentation analysis, trying to understand, because we had an SMB customer base, we had thousands and thousands of customers, and we were trying to be like, we're way too horizontal. We need to be a bit more focused on the right, like, core segments that work for us. We're doing a bunch of analysis there. And we asked that question as part of the segmentation piece. And it's sort of, we kind of knew what the obvious, there were sort of 3 groups that came out of them, and 2 were sort of, we kind of had a pretty strong inclination that was there. But we had this like small group, which for us was actually like recruiters. And we only had, like, out of the hundreds of survey responses, maybe about like 25 recruiting firms in there. The Sean Ellis question was 100%. And we were like, what? And like, it was just like one of these like little outlier things that you're like, that's super. That wasn't enough of a sample size to be totally sure. So we did some qualitative interviews, and there's a whole interesting story sort of behind that. Now, unfortunately, COVID has like completely demolished recruiting as an industry for the minute. So we sort of haven't gone super hard on that side yet, but there has been like, I do think that as you're doing that segmentation stuff, that Sean Ellis can provide some interesting clues as to what might be some other interesting stuff there.
I totally agree. That's a great point.
So a question for you. So like on this retention side, and as you sort of think about that side, look, we started in the SMB. We're sort of moving from, let's say, the S of the SMB to the M and the early mid-market. Obviously HubSpot was, SMB-ish, SME, or however you want to define it, and sort of again moving up, and now serves some huge customers as well, like a full range. I'm quite, we're in Sydney. I'm very close with the people at Canva, who I guarantee you do not have a 90% net retention rate on their customer cohorts. Like, I think their churn is relatively high, but still absolutely crushing it. I mean, how do you think about this across different cohorts? And again, so I actually would love to tack back and loop Shep in on this as well, as like, how was that journey, Shep, over the last like 5 years of like, because there was a huge push at HubSpot to move from, to really like focus on retention, be like, we actually want to like meaningfully drive this net revenue retention piece up. So I'm going to throw to Mark first on SMB versus mid-market, and how different startups in different zones should think about like what the right retention rate is. And then would love to hear Shep about the HubSpot's journey sort of moving, because again, I sort of wonder, is it cross-selling? Is it moving up market? Like, what was the thing that really actually moved?
Yeah. I mean, it's hard to achieve a 90% customer retention in SMB because there's just macroeconomic churn. Like, these are small businesses, their budgets are tough, right? However, so I think it's okay to have 85 to 80 or something, but you have to have over 100% revenue retention, or you will stop growing at some point. Like, just, this is what happened. Like, Gail Goodman, the CEO of Constant Contact, like, kind of taught us this. She was one of the early board members for us, and they were high flying at the time, but then they hit, and she's amazing. And they kind of figured that like their natural like macroeconomic churn was about 2.1% monthly. Okay, so that's like, I don't know, whatever, 20%, 25% annual. The problem, and that's like, you hear that number, and we were like, wow, that's great. That we didn't really know subscription then. We're like, wow, that's really low. Like, every month you retain 98% of your customers. Wow. But then like, once you get to be a $300 million company and you're losing 20% a year, that's 60 million that you have to sell just to have 0% growth. Okay. So at some point you just don't, unless you have 100% plus net revenue retention, you will slow down. And then that affects everything from being venture backed to being a public market company stock, et cetera. So that's the key in SMB. Like, if I'll let Shep talk about HubSpot, but when I'm coaching a company that's pursuing the SMB, I basically try to push them to keep your opening price extremely low and keep like opening friction very low. Because like, let's just take an extreme scenario. Let's say you have 50% churn, okay? But let's say for that's logo churn.
Mm-hmm.
But let's say for the half that stick around, like everybody starts at $10 a month. Okay. It's like really cheap. And like half of them quit. But like for the ones that stick around, it becomes so important to them that they end up paying $100 a month. Right. So that means like you started with 10 customers paying you $50 a month, and you ended up with 5 customers paying you $500 a month. So your logo retention is 50%, but your revenue retention is what, 1,000%, right? So that's how you want to play it. Is now that's not a perfect example, because even in that scenario, half the people that try you are out there saying, I tried it, it didn't work for me. That's not good, right? But like if it was like 75 or 80% retention, that's a business model. Like logo retention with 120% revenue, that's a good business model. So Shep, what did you think about like how it was played out at HubSpot?
So I think the process, so you have 10 years here, right, of experience at HubSpot. And I think the first thing that happened when I was at HubSpot, and Mark, you'll remember this very well, is I think our retention was worse than that 2.1%. It was something like 3%. And there was 1 month when I very first started, I think we had 7% churn in a single month, and everyone lost their mind, right? And I was so new that I didn't really understand like how bad that was, because like 2% versus 7% didn't sound that crazy to me. And you guys had done a study, the leadership, and it basically turned out that lowly sales reps like myself, I was a sales rep at the time, were basically responsible for the churn. Like you could like actually map back which cohort of customers was going to churn more likely based upon which sales rep sold them. And this basically had reverberations in the organization for forever. Like it's still part of our kind of DNA at HubSpot, I'd say. But the process was really always be doing research and trying to quantify exactly what is working and what's not working. But the solutions over the 10 years I was at HubSpot about how to improve churn, how to improve customer retention and that revenue retention changed a bunch. And I like what you were saying earlier, Mark Roberge, around like getting the whole organization mapped to one thing. And I think you can see that like HubSpot started off as a single product selling marketing software, help you turn your website into a lead generation machine. That was essentially it. Then they went into the CRM world and finally into the services stuff. That was all product expansion. But another thing was, just going back to what you said a second ago, was like the recommendation about having a really low entry point. Like that's something that HubSpot didn't have, right? And so over time, we have much more of a freemium model where you can start really low, friction point. Then you can jump up to like 25, 50, $100 a month type stuff, all the way up to thousands and thousands of dollars a month. And then the services and sales org have also just changed the way we've gone to market. A lot, I would say in some ways, a lot less hand-holding, but in other places, a lot more hand-holding. And as you grow, you have more resources, so you can actually do very, very different things for different types of customers. The way we treat, freemium or low-paying customers is way, way different than the customers who are paying us thousands of dollars a month. It's almost as if you're running multiple businesses for different types of customers all at one time. I don't know if that answers the question, Mark Tanner.
Just to add to it, Mark, because having that experience, I think Dave answered it perfectly. And then comparing it to what I see common in practice is where Dave started, which is when a startup does experience a retention and churn issue, they first look at product and customer onboarding. And I don't find the issues to be in there. To Dave's point, it's more pre-sale in sales and marketing. It's the customers they're choosing to go after and the expectations they're setting during the process. And that's like pretty big news to people. And so like if you're out there wondering,
of all the companies I've advised, I would say that's almost always the case. Almost always. Like I was just helping out a company the other day, and it is 100. I listened to one call, and I could tell instantly. It had all of the like hallmark things, like this is a sales problem, not a product problem.
Yeah, and so a couple of things you can do that are very actionable. One is to validate whether your churn issue is the case. If you have a couple of reps, calculate the churn of their customers and see if there's a big variation.
Yeah.
You know, because then it probably is the case. And then two things you could do tactically is, number one, have some component of your sales comp plan be aligned with retention. Okay. And that's again where the power of the early indicator of retention sits, is just give them half their comp when the customer signs the contract and half the comp when the customer hits the early retention, right? So Mark Tanner, you said your new early indicator retention is when in the first 30 days, they get their first proposal approved. Great. That's when the reps should get the second half of their comp, right? And actually you should be willing to pay them more commission on that overall customer than just assign, because that's a higher LTV experience, right? And it's not like we're trying to turn our salespeople into customer success managers. It's just we want them incented to set very good expectations up front, and if things go sideways, to help the customer success manager. That's number one. Number two is a lot of companies have a sales qualifying matrix like BANT, GPCT, MEDIC, okay? These are qualifying matrices that inform us the likelihood that someone's going to buy, okay? Mm-hmm. You need a sister matrix to see how likely they are to succeed, okay? So it's things like, did you get IT involved? Did you get the buy-in of the end user? Like, these are all things that I can sell a deal without doing that. But if I don't get IT's buy-in before I do it, this deal is cooked. My CSM is cooked, right? So you can have you have your sales qualifying matrix, but also have your customer success qualifying matrix too.
And is that owned by the success team or by sales?
No, it's pre-sale.
Pre-sale.
So like when I'm a manager doing my reviews and I'm talking to Shep, I'm like, okay, Shep, you just added this deal to the pipeline. Let's walk through their BANT, okay? Yeah. And then let's walk through their 3 C's that we had at HubSpot, which is content, commitment, concept of a lead. Those were the 3 most popular reasons why people churned. Is they didn't know they had to write blogs, content. They didn't know they had to spend time doing it. They needed someone committed to it. And concept of a lead. So we weren't for e-commerce or like media companies. We were for like B2B companies. So I would just walk through the 3 C's together, just as a checking mechanism to making sure we're setting the right expectations for success pre-sale.
And I think the key to this is that it changes over time. You have to constantly be reevaluating these things. Like, we don't talk about the 3 C's anymore at HubSpot. Like,
totally different
because totally different scenario, right? Selling totally different products to a much more sophisticated market compared to back then. Yeah.
And even a lead indicator of retention, like whatever, 8 years ago when we found that it was 5 out of 25 features, it might be close, but like now that a lot of stuff changes. The company itself builds more products. So there's a CRM, there's a service hub, and the competitive landscape completely changes. And the education of the buyer completely changes, right? So like all this stuff is a moving target.
Yeah. So I think, this is all great. And I know that I know even today that HubSpot, reps are still valued, even if not, I'm sure they are competent, are evaluated on like net retention over time. And if you want to get promoted to the next tier, you need to have certain retention goals. And I think that is very good. And I have been looking at sales rep retention individually. We've got a new marketing attribution framework in Chartmogul that puts out a bunch of pretty graphs that I've been playing around with. And it is interesting to see some differences there.
Hey Mark, can I just add one more comment before we move on?
Yeah, sure.
I want to call out like how potentially revolutionary this whole concept is.
Yeah.
Like, Mark Roberge, you mentioned Eric Ries and like the lean startup. Like that is, if you're in the startup world, if you don't know who Eric Ries is,
groundbreaking.
You're just not paying attention, right? But if you look at most decks, I mean, Mark Tanner, you just raised how many X millions of dollars? I forget. But it's a boatload, 10, right? I want to ask you, like in your pitch deck, was your very first slide about retention? No, of course. I mean, I'd make any bet it wasn't. It was about revenue or customers, like how many of them that you have probably, right? But I think Mark Roberge, I think you would argue that actually you should be leading with retention. And I just think it's pretty crazy that in the VC world, everything's about revenue. But my guess, Mark Roberge, is that you wouldn't. That probably isn't actually what you.
Yeah, I mean that's our uniqueness with stage 2. Like I think like triple, double is the mantra in San Francisco, and it's premature. Like blitzscaling is I think a great model, but you have to be ready for it, right? Yeah. And so like I mean, the reason why is the first revenue deck is that's what the VCs want to see. Like if it's 200% grower, we're going to invest. And if it's not, we're not. But for us, if you're 100% revenue retention, and even if you're growing 50%, I'm extremely interested because we've had great success accelerating those. And for the 200% growers with 70% customer retention, it's a redo, it's a pivot. It's probably a failure.
Yeah. I mean, certainly on our side, again, doing that customer segmentation piece and being like, oh, these customers retain at 120% year on year, and these other customers retain at 60% year on year. It becomes this, I think, like, and that was a very sort of light bulb moment for us a while ago. And like, as Aaron, knows, like we dropped a plan, we dropped a segment that, of our customers we used to serve, who we like had like huge, huge for us, but like large lead volumes coming. Our lead volume has like halved over the past year as we've refocused. We're growing faster than ever before because again, we're sort of coming in. And I do think there's such a huge point around setting expectations correctly. Like, funniest thing is like someone had this line here, it's like, you set the expectations. Like, you're the one in charge of all of your messaging, all of your marketing. You are the one who is doing this to yourself. And if you're not hitting the bar correctly, like obviously you need to like position yourself well and, you're not going to like undersell yourself too much, but you do need to have some sort of thoughtful stuff around there.
Yeah. The quick cliff note there, Mark, is the MQL is often defined based on the highest close rate, the lowest CAC, the shortest sales cycle. But what you just realized is the MQL needs to be defined by the highest LTV. Yeah. And oftentimes like that segment doesn't have the shortest sales cycle, doesn't have the highest close rate, but that's really where it needs to be aligned.
And I would say for us, like, to be honest, like it was also segments where we were like, not like the channels that were like easy for us, that were like smooth and growing and doing well, were not the channels that were super well aligned to the super high LTV. So we were like, crap, like we need to like reorient ourselves and rethink this sort of problem a little bit. And like we've had some good wins. We're definitely still like figuring out exactly the right motion.
Yeah. And it's a very forgivable story, just to like capstone that. Don't worry if you find that as a Series A or B company. We did ourselves, right? We found it. And what you do is like, it's going to take a long time for your net churn to fix itself, because you just spent 2 years signing up this potentially unhealthy install base. Yeah. But if you like, so I love a story where someone comes in and like, listen, our overall churn is retention is only 70%. But 6 months ago, we figured out that this bucket churns at 50% and this bucket only churns at 10%. And ever since then, we've only signed up customers in this bucket. Yeah. And look at the lead. That's a very sellable story. It's just a matter of time that the overall churn fixes itself. So don't worry if you find that. Just move quickly to create that story.
Thank you. And that's the zone we're on. And I actually got to say, like, the path that we're on now is that segment is about to overtake the previous one in terms of revenue and is growing at a very good rate and blah, blah, blah. So I think in a year's time from now, we should be in a nice spot, even on that side as well. Just to sort of tick through to the deck side, I do actually have a few technical sort of VC questions. So one is in the weeds here. So I have to ask questions about CAC and the definition thereof. So I was sort of going through your thing. You were saying, like, as you sort of had this definition around, like, so I completely understand like the sales side. So you talk about like, what is the cost, of an SQL, and therefore, go into the sales rep, conversion rate, blah, blah. But how are you defining on the demand gen side? How are you defining what goes into the CAC on that side? Because there's 7,000 different ways to think about CAC. And are you just taking demand gen and like associated salaries? Are you taking all of marketing as like all of marketing is demand gen? Even like brand and, content and other pieces like that. Like where do you sit and how to think about like what cost to attribute to that part? And then second question is, other than that, like quite sophisticated CAC to LTV model that you have there, what are the other ones that, and so obviously retention as well, but what are the other ones that you're sort of, when you're speaking to a founder and looking at a deck, okay, you've looked through CAC to LTV, looks good. You've looked through retention, that looks good. Are you done? Are you like, that's all I need to know, this like plus some degree of a growth rate? Or like, what other things are you sort of prodding on and looking into?
Yeah, a lot of stuff. So the first one, no one's asked me that before, but I have done a lot of like cost attribution exercises at Harvard and like other places. It's tricky stuff. I don't know if I have like a very like, look out, there's a big pothole here, or like really firm advice on it, other than just be consistent. You know, like nothing's going to be perfect. Yeah. And just like, as long as you pick something that's logical and be consistent, like, ideally on the marketing side, you're putting in all the costs that are going to scale, like going to have to scale with scale. You know what I mean? Like, I don't know. And on one way I can argue like our PR firm could be left out if it's just a brand and buzz thing. On the other hand, that is contributing to the overall like contribution. So I don't know. Typically I would just take the overall marketing line, which includes salaries and everything, and just divide it by the customers. Like that's really what I do. But Shep, do you have an opinion on that at all?
I honestly don't. I think it's a very complicated thing, what you could leave in, leave out. I think consistency is the key. I don't think I have more to say on it.
Yeah. They should probably like just dividing the whole line number, because then marketing can't cheat, by like stuffing people into the places where you aren't. Like, I mean, I don't know. Unless it's like customer marketing and it's not associated with new customer acquisition, like it's circumstantial. Go ahead, Mark.
I think the thing you want to avoid is the infighting between teams, right? Because at all companies will go through moments where the numbers don't stack up the way you want them to be, and the last thing you want is sales versus marketing arguing over their true impact to the problem, right? And so I think consistency is the best way to avoid that.
I think our sort of view on this is like, it's fine to take an overall number on the marketing side and then take an overall number on the customer side. And I know that's blended and there's imperfections there, but I think as an overall health check, that's like one frame. And I think the other thing you need to do is when you're trying to build out a new channel, you just need to be like it's okay to be quite strict and narrow in that definition of how that channel is performing to an acquisition cost, and sort of try to like understand that particularly well. And it's okay to sort of leave some things out of that initially to sort of try to dive into that space. But other than that, we're sort of
agreed.
All right. So we've sort of like morphed into the sort of the go-to-market fit side of the equation here.
Sure.
Sort of, I should have signposted this a bit more. But I suppose like on this side, like I'd just be keen to sort of find out like we're very much in this stage, and we're sort of getting ready where, we've got 5 reps, we're adding a couple more at the moment. So we're not quite in the full on ramp up rep side, but we're sort of, I think we're hopefully getting close. Would love to know like what you think some of the biggest mistakes that founders typically make in this go-to-market stage as they sort of think they're about ready to scale, and that they think they're sort of, which we sort of are like, we sort of feel like we're on the cusp of being able to sort of go over that hill. Would love to know like what you think we really need to have bedded down before.
Sure. So I think it's really just like a sequence of focus. So just to get back to the framework, remember product market fit, then go to market fit, then growth and moat. And so we've covered product market fit. It's based on retention, but that's a lagging indicator. So you have to have a leading indicator retention. And what's nice about this framework is it clearly tells you where you are, but also gives you guidance as to how to make go-to-market decisions to accelerate through each phase, right? So the rep that you're going to hire in the product market fit is different than the go-to-market fit, is different than the growth and moat, okay? The rep in the product market fit is almost like half product manager, half account executive, right? They can sell, they can move a sales process, they can handle objections, but they're also very good at stepping back on a week's worth of sales calls and seeing the patterns and communicating to the engineering team, right? You see a lot of founder selling. Don't talk to me during product market fit about your pricing model. Don't talk to me about your comp plan. Don't talk to me about a cold calling campaign. Like you should be able to like get like 50 introductions to customers through your board, your network, whatever. That's fine. Not scalable, but who cares? You're doing unscalable things, right? Comp plan, like I don't think a comp plan's needed here. Like the whatever rep is there, put them on equity plan and like let's just go, right? Like pricing model, it's like, dude, I got 10 customers. It's like, I'm pitching a customer. I'm just like, I'm going to charge like $50,000 a year. I'm just looking for 20 beta customers to give an 80% discount to. It's not free, but it's like price for commitment, right? So that's the whole thing there. David Cancel, founder of Drift, former head of product at HubSpot, when he was in Drift's product market phase, he was literally on airplanes flying to customers to do onboarding for customers that were paying him $50 a month. That is the right behavior as a founder. Okay. It's doing unscalable things. It is hard to come up with an idea and to get 80% of your customers to succeed with that idea. So put all your eggs in that basket. Okay. Now we move to go-to-market fit. Okay. Product market fit. Congratulations. You came up with an idea and you've proven that consistently you can sign up customers and make them successful with that idea. Okay. Now in go-to-market fit, we have to do it scalably. We have to do it profitably. Okay. And in software, we usually don't look at that as like GAAP accounting profitability, right? We look at it as unit economics. Okay. So LTV to CAC greater than 3, payback period greater, less than 12. Why? Because it isolates the go-to-market costs from the overhead costs of like a finance team and a product team and stuff that doesn't necessarily have to scale with scale. So that's what unit economics does. Okay. Now the problem is that unit economics, like retention, is a lagging indicator. Like if I want to understand what's the unit economics of the customers I acquired in September, it's going to take me a while. Okay. So I need to extract that back to lead indicators. And that's just algebraic. Like if you want an LTV to CAC greater than 3, you can extract that back to how many appointments per week does your SDRs have to set? How many of those make it into the pipeline? How many of those become a customer? How quickly? What's the average sale per customer? These are like the leading indicators that we can dashboard. Okay. And so once we set those up, as long as we continue to perform above what our business model is calling, then we have go-to-market fit. Okay. So what matters at this point? Having a sales playbook matters, right? It's no longer founder selling. Like we need someone that can build a process. Shep's actually really good at that. And we need to like start running that process. We need at least one scalable demand gen channel. Like introductions from the board is not going to scale. Like we can't hire 10 reps and just do that. Okay. We need a content marketing program. We need a cold comp program. We need something. Okay. The pricing model and the comp model are hugely important now. This is like, has a huge impact on our LTV to CAC and our unit economics. So we have to figure that out. Okay. So those are the things that we have to work on at that point. And then once we have that, we can move into the growth and mode stage.
Awesome. Shep, anything?
Yeah. I have loads of questions. So I'm gonna channel all of the questions I get from startups from Mark Roberge here. So often the questions I get are the timing ones. So a lot of founders will be like, oh, I really know I need to have BDRs, but do I actually need BDRs? And when should I build a BDR team? So maybe start with that one, Mark. You're talking about building like a channel, a way of getting kind of leads into the funnel. One of the ways you do it is a cold calling program. Do you have any recommendations on when and if startups should do that, like based on like products or price size or whatever that might be?
Yeah. So if you're at the product market fit phase, which is like, we're just trying to get 20, 30, 40 customers to like have a chance to, should I hire a BDR? It's so circumstantial. Like, first off, you as a founder, what are you? Are you like a introvert engineer that's terrible at talking to people? Or are you like an ex-salesperson from like, wherever? You know what I mean? So like if you have chops, then you could probably go through your network, et cetera. So it's hard. But if you just like, and again, like also, is your market amenable to a cold call, right? Like salespeople are very easy to cold call. They all pick up the phone. You want to get a salesperson to call them back, you leave a voicemail with just your name and just your phone number, and that's it. Every single salesperson calls you back. Okay. So like, but engineers, they don't even have phones. They don't have phones, right? So you can't cold call engineers. So like part of it is that, right? Okay. And then, so once you get to the go-to-market fit phase, yeah, again, it really comes down to that. Like what are we most bullish on? There is no universal right sales hire. There is no universal right demand gen channel. There is no universal right sales comp plan or org design. These are all relevant to your context, and your context is your buyer and the product you sell to them and the stage of your business, right? So for this demand gen decision, it largely depends on your buyer and what they're receptive to.
I think
one of the things I've been really, go ahead, Mark.
I was going to say, just to say to our side, I mean, I think in SMB land, as we sort of moved up, like, we sort of found that like, we did an experiment with like sort of BDRs, SDRs at one stage, and we ended up, there was value there in terms of like improving the meeting booked flow and sort of, doing like other sort of pieces on that part and improving so much time. But like the economics weren't there. Like at the time, average deal price for us was like 1K, 2K. And now it's more like 5, 10, 15K. And so we're just starting to relayer that in. And I would also say that we're sort of moving from a 100% inbound model, or 99% inbound model, to like layering in a little bit of channel and a bit of outbound into it, to sort of try to get a bit more, I mean, because I think we sell to salespeople, like sales and marketing folks, and as you say, that sort of that part can work quite well, and I think recruiters would also work quite well. But I think that
super common path, Mark, and just like to give you guys some counsel there, as well as like I'm sure a lot of people are going through this, is believe it or not, when we actually did our customer retention analysis by channel, so we could basically boil all of our acquired customers for the first 10 years down to either from inbound, like marketing, from cold calling, or from our partner channel. And the churn rate for customers from the cold calling channel was substantially lower than the other channels, which is kind of interesting. And it makes sense when you think about it.
Super targeted.
Yeah, it's like super targeted, perfect fits, right? And like, there's no real arm twist. The inbound lead, like, they're like, oh, I saw Halligan at the conference, and I've read Dharmesh's book, and I love it, and oh, like you could tell me anything, I'm signing up, and they might not be a good fit, and furthermore, they might even be a good demographic. But the cold calling, they're so precise on calling great fit companies, and usually like slightly larger deals. And so you just have to think about that, because you got to factor that into your channel analysis. If you do see a variance in churn rate by channel, don't apply the same churn in your unit economics formula. You're discrediting your outbound. So that's one way that it works. Typically, when you go upstream, you can make it work. The other thing in the transition time is it's sometimes useful to not only specialize your BDRs on the cold call. Like, don't give your BDRs inbound leads plus have them cold call. They won't cold call. Okay. Just make them cold call. That's it. Also consider specializing your account executives too. Okay. Cause like if you can afford it, if you have a big enough team, like if I had like 5 reps and I wanted to experiment with cold calling, I think you're going to be better off specializing 1 rep on all the cold appointments set by the BDRs, and don't give them any appointments from inbound, and have the other 4 reps stay on inbound. Because even at the appointment level, an inbound generated appointment is easier than a cold generated appointment. And so you won't figure it out unless you isolate it, at least temporarily.
Yeah. So the other chef in my life, another sort of sales leader who I sort of go to for a bunch of advice, is actually sort of quite against that as a model in terms of having like BDRs and A's sort of split between inbound and outbound, because he says it there's like a culture risk, basically, can cause a tension between the teams, because like, look at these bloody lazy inbound reps. Everything is so easy. It comes to them on a platter. Like, we're over here grinding and like, and then, sort of feeling, jealous about like comp, or just there's all sorts of little things there. And I just sort of, what's your feel?
Well, my response there is like, you have to make the 2 jobs equally annoying and attractive. Okay. And so different layers you can pull is quota and comp. Okay? Like, right? Like maybe an inbound rep has a higher quota, okay, and an outbound rep doesn't, and because the LTV is so much bigger, you're better off. I personally don't like to use BDRs and inbound leads. So it's like, if you want someone to set an appointment, join the cold calling team. If you want really nice inbound leads, you have to prospect yourself. So there's pros and cons to that. The pro is like an inbound lead is super valuable. And I'd much rather have an experienced 28-year-old account executive that's been with us for 4 years talking to them than a new 22-year-old off the street. But the downside is, we all know that if you call the inbound lead within 2 minutes, your success is much higher than if you wait an hour. And it's hard to instrument an AE team to do that. So just however you want to play it, there's a lot of different models out there.
I think the key, Mark, that you're really talking about here, though, is 2 things. Is 1 is it has to be based on your customer. And 2, you have to be willing to experiment, which also means you have to be willing to fail. And one of the things that I see a bunch of founders do, and there's really good reasons for this, is like they're really scared to try things. And I think the 2 reasons for this, in my opinion, is like they have limited funds, which means they have limited time. So they want to make sure they get it right. And then the other is there's a little bit of like monkey see, monkey do, where either they're being advised maybe inappropriately, or they're a part of a founder group type thing, and everyone seems to be doing this thing, like hiring a BDR team, for example. And it's not really what would be best for their company. And there's all sorts of startups out there who, get to 100 million in revenue, and their go-to-market channels are all very, very different.
Yeah.
Like I think HubSpot was pretty unique. Like we were pretty much 100%, not totally 100% inbound, but mostly inbound all the way up to $100 million and beyond that.
Yeah.
Yeah. It's a great point, David. It's like probably the most valuable thing I learned from Halligan. He had so much to teach us, but that was the one that really stood out. And I don't think we talk about enough in the startup ecosystem is I do find your point, Dave, like the founders are willing to take crazy risks when there's no revenue, but once they get to 5 million and then 10 million and then 50 million, they're like, they don't want to screw it up. They're like, oh, they're like cautious on it. And Halligan was like, the decisions he made, he literally like, it was crazy. I was like, are you kidding me? Like rapid comp plan changes, rapid pricing and packaging changes, rapid leadership changes. And to his point, like you don't have, even if you're at 20 million, your business is always at risk. You play in a very risky area. And if all of a sudden you start getting conservative, you're going to stop growing and you're dead. Right. So we, as founders, we have to realize that is like, don't play it safe now that you hit 20 million. You start playing it safe, you open the door for the competition and you're going to lose. So,
yeah.
I mean, Halligan was saying that as we were going public, like he still says we're, HubSpot's coming up on $1 billion in revenue, and he's still thinking about how do we need to change to get to 7 billion or 10 billion in revenue.
I think, look, we're at time here. So I think we're going to sort of start wrapping up, which is a real shame because I've genuinely learned so much on this call. That's not me kissing ass. That's just like, I'm going to re-listen to this and sort of put in place a few more things. I think like just to sort of speak from a personal journey sort of side, I mean, one of the real joys, like we're 6 odd years into this journey with Quilla. I definitely thought we'd be where we are after like 3 or 4, but like, I think that one of the real joys of this job is that at each stage it is hard in a different way. And it's this always engaging puzzle that is always slightly changing. And this part that you thought you'd solved is now sort of, has some like decay or entropy or whatever you sort of need to go and fix. And the game, you need to sort of challenge yourself and learn new things and keep growing. And I think that I love to hear that, you guys sort of speaking about like how much you learned from Halligan and how much you did sort of, challenge and push the company. And that sort of is inspiring. And I think, hopefully, Dylan, my co-founder, and I can try to emulate some level of that. But I think that's the joy, a little bit of the burden, but the joy of being a founder is sort of going down that path and sort of, and being on this ride that isn't just, it's not the same loop every time. It's a different roller coaster each year. Look, we didn't get a chance to talk about the sort of the growth and moat part heaps, but I would just like strongly recommend everyone go and check out the ebook. It's on the Stage 2 Capital website. It's about like, there's a deck I've seen that's about, I think like 20 slides and the book itself is about 60 pages or so. I think you'll get through it pretty quickly, but then I think you'll find yourself rereading it and hopefully re-listening to this conversation and getting a bunch out of it. Mark, thank you so much for joining. Shep, have a great day fly fishing. What a glory. And thank you everybody for watching.